Hello, everyone. Welcome to episode 2 of the CRT 2026 mentorship. So, let's not waste any time or get caught up in unnecessary talk. We're going straight into today's topic. This lecture is all about lower time frame methodology, and trust me, it'll be 100% more valuable than the paid mentorships you see from Twitter gurus. We're going to break it down step by step and cover everything from how to approach LTF entries to understanding entry models and how to align them with the bigger picture. By the end of this episode, you'll have a clear framework for recognizing and executing entries on a lower time frame. All right, so let's first talk about what an entry model actually is. The entry model is one of the most important tools in trading, and I know it's the last thing that's come in trading, but it's the most important one, right? Once we've identified the correct candle range and the draw on liquidity, we don't just jump in blindly, we wait for an anchor point to form. That's where the entry model comes in. It provides us a clear framework for when to enter. And in trading, especially in ICT and CRT methodology, timing is everything. If your timing is wrong, the entire setup can fail, right? In trading, even a strong model or a perfect analysis won't work if you enter at the wrong time. So, timing is everything. That's why entries should always be based on key times, during kill zones, or at specific time or specific refined sessions. Ah, don't worry, we'll cover time and kill zones in detail later on in this mentorship, step by step. This mentorship is very structured, systematic, and predefined, right? Starting from the basics, moving step by step, and slowly to intermediate and then advanced. I've designed it this way so that you can absorb the knowledge easily, and trust me, it'll be 100% more valuable than the paid mentorships you see from Twitter gurus. Now, the second thing an entry model gives you is clarity on where to enter. This means identifying the right key levels and correct CRT to trade from. And then comes the big question: why are you entering? What's the reason behind this trade idea? Is it supported by higher time frame liquidity? Is it aligned with a key level? Does the trade have a clear time and price based narrative? If you don't have good answers to these questions, then honestly, it's not an entry, it's just a guess or gambling. That's the difference between gambling and trading. Without an entry model, even if your higher time frame analysis is perfect, your execution will still be random. And remember, analyzing the chart and actually executing the trade are two completely different skills. That's why entry models matter so much. They give you structure, confluence, and discipline. All right. Now, there are multiple entry models out there, but I'm going to teach you the one that's the most modern, the most practical, and the one that actually gives you high R to R trades, and the one that actually fit perfectly with CRT, Model 1 entry, right? Model 1 is all about a confirmation based approach, and that confirmation approach offer you low risk and high reward, meaning it give you high reward in low risk, which other entry model don't, and it very easy to execute with clear rules for both entry and stop loss placement. Now let's get into it. For a Model 1 to be valid, it must serve two key purposes. They either take out liquidity by purging below lows or above highs, right? This could be candle range highs or lows, or it could be old highs and lows. Now, second, they fill liquidity by filling FVG or testing existing order block, right? Meaning it rebalances and imbalances or testing already existing order block. Now let's discuss Model 1 in the form of purging liquidity. You can also call this the order block entry, but remember, this is not ICT's OB. This is CRT's advanced way of using OB. Here's how it works: a candle or a series of consecutive candles that digs below a low or above a high. When engulfed in the form of closes above or below and comes back to test that specific candle that purged liquidity, that is called a valid Model 1 entry. In summary, the candle that purges liquidity by digging below or above and then gets engulfed becomes our Model 1 entry. Okay, now Model 1 in the form of filling liquidity. The second way Model 1 works is through imbalance rebalancing, right? When a candle fills liquidity by rebalancing an FVG, and then that candle gets engulfed, it becomes our model 1. Now, with this specific candle market filled liquidity, right, by filling this FVG, or by rebalancing this imbalance FVGs, right? So when market engulfs this candle in the form of closing above them and test this specific candle, it will become our model 1 entry. So let's look at the real chart. As you can see, we have this high, and as you already know, above highs and below lows, there is always liquidity resting. In this example, price purged this high with this specific candle. Now pay attention to this candle right here. This specific candle is the one that actually purged the liquidity. Once that happened, the next step is very important. We wait to see if price closes below this candle. And in this case, that's exactly what happens. The market closes underneath it. After closing, price doesn't just leave it behind, it comes back, retests that same candle, respects it, and then expands lower from there. That's a complete Model 1 sequence right in front of you. First, liquidity gets taken, then we get the close confirming the engulf, then the retest of the candle that purged this high, and finally the expansion in our direction. This is exactly how Model 1 works. It's clean, it's structured, and it removes the guessing part from your entries. Okay, so in this example, the market purged this low with this specific candle. Now, what we want to see next is a close above that candle to validate it as a Model 1. And if you notice here, the market did close above, but it didn't happen in just one candle. It took a couple of candles to close above that specific candle. The important thing to focus on is this. Once the purge happened, the market completely respected that low. Not a single candle managed to close below this specific candle. That respect is exactly what makes it a valid Model 1 setup. So the sequence is simple. Price purged the low, then it closed above this specific candle, came back to retest that candle, and from there it expanded higher to these highs. Now, in this example, the one I'm showing you here, it's a bit different from the previous one. Earlier, we only talked about a Model 1 that purged liquidity, but in this example, you can see something even better. The candle is doing both jobs at the same time. So what happens here is that price first purges this low with this specific candle at the same time, and it also fills liquidity by rebalancing this fair value gap. After that, the market closes above this candle, comes back to retest it, and then expands higher. So basically, in this Model 1, the same candle serves both purposes. It purges liquidity by taking out this short term low, and it also fills liquidity by covering, rebalancing the imbalance. And when you get this kind of setup, it becomes a high probability Model 1 because you've got both conditions lined up together in one move. Now let's talk about the downside of Model 1. Because let's be real, everything in trading has two sides, right? Every concept, every model, every entry technique has its strengths but also its weaknesses. The problem is, most people only talk about the positives. They'll sell you the outcome, they'll show you the reward, but they'll never mention the risk or the limitations. But if you want to be a complete trader, you need to know both sides of the story. So, what's the downside of Model 1? Honestly, there's just one main issue. Model 1 relies on the idea that after liquidity is purged, price will retrace back into that order block or that specific candle to give you your entry. But here's the thing, the market doesn't always play nice. Sometimes after the purge, price just takes off impulsively, explosively, without coming back to retest that specific candle. And when that happens, yes, you miss the trade. Now, is that a problem? Not really. That's just trading. You've got to accept that missing trades is a normal part of the business. It's way better to miss a trade than to force something and take a loss. Think about it. Missed trades cost you nothing, but forced trades can damage your account and your psychology. So, how do you deal with this downside? Simple. You journal these situations, these type of market condition. You track when the market fails to retrace and ask yourself why. Was it high impact news? Was it a trending market environment? Was liquidity already balanced in the form of filling FEG? The more data you collect, the more patterns you'll start to see, and over time you'll be able to anticipate when the market is less likely to come back for that retest. But the key takeaway is this: don't be afraid of missing trades. It's part of the game. The goal isn't to catch every single move. The goal is to catch the right ones with consistency and discipline. So, yeah, that's the one downside of Model 1. Keep it in mind as you trade, and it'll save you from frustration down the line. Now let's talk about when to use the wick and when to use the body for your entry in Model 1. This is a very common question right now. It depends on the market conditions and the way price action forms around that specific candle that purged liquidity. There isn't just one fixed rule. You have to read what the market is telling you. So let's break it down with a few scenarios. The first case is when to use the opening price. Now, if price closes just above or just below the open of that specific candle that purged liquidity, whether it's a purge of candle range high or low or old high and low, then your entry should be on the body right at the opening price. Now, here is another scenario where you prefer the opening price. Now, the candle that purged CRT high and low is thick and heavy, like a big beefy candle. So in those cases, using the opening price gives you a more reliable and tighter entry. And yes, sometimes you can still consider the wick here, but generally the open works best when the candle is large and strong. Now let's look at the second case, when to use the wick. Now, if price closes above the high or below the low of the candle that purged liquidity, then you mark that high or low and use it for your entry. Meaning, in this scenario, you can use the wick for your entry. Another scenario is when the purge candle has a small body but a long wick. In that type of candle structure, the wick carries more weight, so you would rely on it for your entry level. The main idea is simple: you want to follow the market's lead, not your own preference. If the close is just above the opening price, use the open. If the close breaks beyond the high or low, use the wick. If the candle is large and strong, the body matters more. If the candle is small bodied with a long wick, then the wick matters more. Now, your job is to read the behavior of price, not force it into your own rules. The market will always show you what to use. You just need to slow down, observe carefully, and align with what price is actually doing. Now, here's an extra tip for you when it comes to Model 1. Model 1 isn't just something you use for execution on the lower time frames, you can also apply it on the higher time frames, right? For analysis, for context, and for identifying draw on liquidity. This makes it much more powerful because now you're aligning your short-term trades with the bigger picture. Let me give you an example. Look at this DXY daily chart. What did the market do? First, it filled liquidity in the form of filling this imbalance, and then closed below the candle that filled liquidity. After that, price retested that candle and expanded lower into the liquidity. Now here's the key. Once you see a close like this on the higher time frame, your next step is to drop down into the lower time frames. And that's where you position yourself with LTFCRT and targeting the liquidity that the HTF is already drawing towards. Now, let me give you another clear example. Take the Eurodollar 3-month chart. The market purged an old low with this specific candle, then closed above it. Once you see that higher time frame close, then your job is simple. Go down to the lower time frames and align with that move and positioning yourself toward the obvious liquidity. This is the other dimension of Model 1 that many of you don't know. It's not only for pinpointing entries, it's also a framework you can scale up for HTF context, so your lower time frame setups always ride in harmony with the bigger market direction. All right, so now let's talk about time frame alignment because this is something really important, especially if you are trading CRT and Model 1 entries. If your higher time frame and your lower time frame are not in sync, then you will always feel lost. So we need to fix that. Now, the alignment that I'm about to give you is especially for CRT and Model 1. Okay, now, if you are trading a monthly CRT, then your lower time frame should be the daily chart. That's where you will frame your entries and look for model 1. If you are trading a weekly CRT, then your lower time frame should be the 4-hour chart. And if you are trading a daily CRT, then your lower time frame is the 1-hour chart. Now, if you are trading a 4-hour CRT, then your lower time frame will be the 50-minute chart. And if you are trading a 1-hour CRT, then your lower time frame should be the 5-minute chart. So this is the clean alignment that I want you to remember. It's simple, it's structured, and it keeps you from guessing. And don't forget, this alignment that I'm shared with you right now is just for CRT and Model 1 entries. Later on, we will also go into other ways to use time frame alignment, like for analysis or for expansion phases, but for now, just lock this in your head. And if your higher time frame CRT and your lower time frame Model 1 entries are moving together, you will always trade with more confidence and more clarity instead of just pressing buttons randomly. Now, let's talk about the lower time frame methodology. This part is basically a continuation of the first episode. In the first episode, we discussed what candle ranges are, how to select them, and the different types of candle ranges. But we didn't dive into the lower time frame. So from here, we'll start focusing on the lower time frames and understand how price action behaves inside a CRT range when we zoom in. Before this, I explained the entry model and time frame alignment first. And the reason is that these two concepts are extremely important for understanding lower time frame methodology. If you don't know how the alignment works or how to apply the entry model, then once we shift to the lower time frame, you'll end up confused. So that's why I cleared that part first. And now we can smoothly move into the lower time frame methodology with a clear understanding. So let's break it down step by step. So on the left side, we've got the candle range on the higher time frame, and on the right side, you can see the price action on the lower time frame. Basically, on one side, we have the higher time frame candle range, and on the other side, we're observing what price is doing inside that range on the lower time frame. Now, which specific time frame should we use on the lower side? And that's where time frame alignment comes in. I already explained this earlier, but let's quickly go over it again to keep everything clear. If the candle range you're looking at is monthly, then the price action on the right you see is on the daily time frame. And if the candle range is weekly, then the lower time frame should be 4 hour, and so on, following the same alignment I gave you before. Now, here's how this framework works. First, we patiently wait for the CRT, high or low, to be purged. Once the purge happens, we will going to identify the candle that purged the CRT, and once you find that candle, mark it out. That candle is now your main focus. Now, in this case, the CRT high was purged with this specific candle right here. So what we'll do is mark out this candle and wait for price to engulf it. When I say engulf, I simply mean that we wait for price to close below this specific candle. Once the market closes perfectly below it, the candle that you marked out turns into a Model 1. And we'll place a limit order at the low of this specific candle with our stop loss above this candle's high or above this swing high. And for targets, we aim for the opposite end of the CRT range, or we can take partials at 50% of the range, depending on how the market condition are. Okay, now what you're seeing here is a clean graphical representation of the lower time frame methodology, just to make sure the concept stays crystal clear before we jump back to the live chart. So this is our first candle. You can see it's open, low, high, and close. From this candle, we identify the first candle's high and low, and this essentially becomes our reference range on the lower time frame. Once this is set, our job is to wait patiently for the next candle to step in and do its job. What we want to see is the next candle open right here and purging the high of this first candle and creating a potential entry opportunity in the form of Model 1 entry, and then low and close. This graphical example is just to make the structure clear in your mind. First, we define the range, then we wait for manipulation to happen. And once that manipulation candle closes, it gives us a clean, rule based entry. And that's the beauty of CRT. It's clean, it's systematic, and you're not rushing. You let the market show its hand first, then you react with structure and alignment. Now, let's move forward and see this same concept play out on a real chart so you can actually visualize how each step connects together. In reality, after CRT is purged, the market can behave in many different ways. Sometimes it gives you a clean V shape reaction, sometimes a W shape, and sometimes it just goes into a choppy consolidation phase before finally moving. I can confidently say that no one else on the internet breaks it down for you like this, but this is the reality of trading. You can't ignore it. So, mentally prepare yourself for every type of scenario, every type of reaction, and for every phase of price. Because if you only expect clean textbook setups, you'll get caught off guard when the market behaves differently. So, okay, now take a look at this example. This is an M shaped reaction. Price purge, the CRT high, respect the key level, formed a clean model 1, retested it, and then expanded lower directly. Clean, easy, and simple. Now, let's talk about why I chose this specific candle as our model 1 entry. If you study this price action, the market filled liquidity with this particular candle. So technically, this could also have been considered a Model 1. However, notice what happened right after. The market purged this short term high with this another specific candle. This purge shifted liquidity, making the second candle the more valid Model 1 according to the framework. That's why my Model 1 is marked on this candle, not the first one. Okay, let's also discuss a V shaped reaction inside CRT. Here's what happened. Price purged the CRT high, then tapped the key level and closed back below this specific candle that filled liquidity. After that close, price came back to retest the candle, and from the retest, it dumped sharply lower. That whole sequence is a classic V shaped move inside a CRT: purge, close below, retest, then expansion. I think I also took this trade as well. You can check the execution on my Twitter if you want to see it in real time. All right, that's it for episode 2. Study these examples thoroughly, take proper notes, and practice spotting the sequence on your own charts. And if you found this helpful, hit the subscribe button and share the video so other people can learn too. See you in the next episode. Bye.